to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities. And if you have any questions on the share or bond market, pick up the phone, call us 1300 30 34 35. The email yourmoney@skynews.com.au. And joining me tonight on the panel is Rudy Philip van Dijk from FN Arena and Francesco de Stratis from Ord Minnett. How did I go with that pronunciation? Seriously? I have killed it. Right, turn it off, guys. We'll go home now.
I think you need a European tongue for it.
I do. Yes, that's true. We can talk, absolutely, equity world. We can talk in a second, but tell me about business. How's business at all? How's it all, joyless recovery? Is it, I mean, I'm not trying to denigrate any of the stockbrokers, but it feels like there's a sort of semi-joyless recovery in terms of we've gone quite far, but pressure's still on margins, and no one seems to be buying with gusto. Is that or I got it wrong?
Yeah, look, in some areas of the market they are. Volumes aren't what they used to be, obviously, but they're starting to pick up, I think. And I think we're starting to see some of the maturities of term deposits and things starting to flow through into the equities market. Well, we are on our desk certainly, but business is still tough, and it's never easy to sort of choose where the market's going to go. But valuations on some stocks look a bit stretched, so it is hard to be sort of buying at these levels. But I think with the volatility that's been created from overseas, it is creating some opportunities day to day here and there.
It's a funny thing, Rudy, in that it seems to be the equity market and the bond market have been running at the same time, and traditionally they've been opposites. If one rallies, the other gets sold off. But at the moment, the investor seems to be a bit confused. They seem to buy both, and it's reluctance on them both, I guess, to some extent.
I'm not so sure whether... I think we have to make a distinction here between the professional investor and the retail investor, I think. I don't think the retail investor is confused. I think the retail investor is simply being very cautious, having been burned twice within sort of like the space of a decade. And as Francesco also said, I mean, that's my view as well. It's not like the share market is offering screaming value. It goes up on very low volume, but it goes up nevertheless, and that makes it not very easy if you're sitting on the sidelines and you go like, listen, for example, I'm waiting for CBA to come to a level where I feel comfortable buying it, and it just never gets there. It doesn't get there.
And to some extent that becomes a self-fulfilling prophecy because of what the fund managers need to do. They can't afford to lose against that index, so they start to buy it anyway. They start picking, and that creates that sort of momentum that they're reluctant buyers, but everyone's sort of into it.
Yes.
Yeah. Well, a lot of your fund managers mandate it as well, so if they've got an influx of cash, they
have to. Exactly. They have to. Yes.
Well, it's nice if they can put in the cash rate at 2%, 2.5%.
No, because traditionally there's always the underlying assumption that the professional is much more intelligent. He knows when to buy.
But we know that's not true.
But exactly, because he has to buy. It's his mandate. It's his job.
The professional isn't that intelligent. I've talked to him for years. There is a few, not many. The US have got their house in order. In your mind, happy days, plain sailing, it's all good, or have we're going to say we're kicking the can down?
Look, I think you're right, kicking the can down the road for another 3 months. I think obviously they've got 3 months now to start negotiating again. If they sit back on their laurels and say, well, we've done this and we can sort of wait for 3 months and then go at it again, I think they're kidding themselves, because I think they're still relatively poles apart about what they want to achieve. So I think they really need to sit down and talk for the next 3 months and really come to some sort of conclusion.
How do you see it playing out?
To me, the big question mark still is, and what has opened up over the past few years in the US is this humongous gap between Wall Street and Main Street. And you see, actually, but I would argue that the average American has become poor over the past few years. But you don't see that in the share market. The share market is...
the average American will agree with you. This jobless recovery means you've just been belted. That's a belted recovery.
Yes, and I'm basically waiting for a point, and I'm certain at some point it will catch up with Wall Street. That it's a fact historically that the labor market in the US and company profits in the US, they're basically opposites. They've been hiring record profits. So at the moment, I think it's a case of be careful what you wish for. But if they start hiring, it has to weigh on profits. It has to weigh on margins.
Absolutely. I mean, I've been saying this for a while, and I've got it wrong. It's just that they haven't had a wage increase since 2007. No one's had a wage increase.
No.
And so once they start to get the employment number down to where they're comfortable with the taper, that just puts pressure on companies, because people will say, so long as there's not 1,000 behind me in the queue, can I have a pay rise? Can I have a biscuit?
Yeah.
And it's, you know, they know it. I talk to the people in the States still, and to this day they say, look, it's the employment market is so fragile.
Yeah.
You can't pop up, because if they see you, they'll shoot you, they'll move you on. It's just, you know, they'll get rid of
And
it.
that'll continue until, you know, the demand for labour starts to increase considerably. And what happens in periods through the GFC is, you know, companies will strip out, you know, labour that's, you know, not efficient.
Yeah.
And they'll get their house in order, and they'll become much more efficient, and they'll squeeze as much as they can out of the labour force they have. You know, when things start to pick up, they'll increase overtime rather than employ and train new people. And they'll get to a point where they can't squeeze as much as they can out of the labour force, then they start employing. And I think we're a little way down the track before that starts happening.
Oh, I agree, we are. I mean, it's not going to happen on Monday, particularly
And by the way, I
furloughs
also think Australian companies are so far behind. They're only catching up on this right now. You know? They've been way too complacent on that perspective.
Well, I'm of the view that since the change in government, if you were to do a search for the word productivity in all the papers, it would outweigh everything. It's what the Business Council wants, it's what the government wants. You know, there'll be some sort of IR reform. It's not necessarily what the person who works in a cafe wants, because there'll be this loading that gets cut. And I feel that there's that's part of the business confidence numbers.
Going to happen.
Yeah, yes.
The government hasn't said they're going to do it, but they...
They've got to be careful politically, though, because, I mean, the last coalition government was voted out mainly because of the...
Couldn't get it right.
The industrial relations laws they put in. And I think they went too hard, too fast to one side. You know, in hindsight, they probably should have done it on a gradual approach to make it a little bit more flexible. I mean, that's the difference between the US and here is they've got a much more flexible labour market that they can do these things a lot quicker than the Australian labour market can.
I mean, I suppose we could look at productivity, get rid of those entitlements, those, you know, travel entitlements. That would be productive. So, I mean, there's got to be that...
You mean political?
Yeah. I mean, there's got to be some sort of give and take on all those fronts. Was there any winners out of this debt ceiling debacle? I mean, did you interpret there to be a winner anywhere?
I see losers. I'm not so sure whether there's any winners. Maybe they become winners by default because there's losers.
Yeah.
I think that the hardline Republicans, they've become the losers,
I think the winners were the Republicans, the moderate Republicans, and Obama. And Obama's obvious because he stood up and said, look, you know, this is my legacy, move on. Yeah. But the moderate Republicans, if you look at the press now, Mitch McConnell said, for the new members, they now know what a comprehensive smashing feels like, what you know, this horrible loss feels like. You know, McCain's coming out saying this was a disgrace. Lindsey Graham from Georgia was saying, you people, like, this is the bloodiest notice I've ever had in my career. And they all look to the Tea Party and they say, it's your fault.
Yes.
And I feel like Obama can see that, and it might make him want to give some sustenance to the moderate Republicans.
Yeah.
You know, for the next 3 months, if they can get a deal together before the 3 months, he can say that's how business is supposed to work with politics. And I sort of feel that maybe they're if you had to find winners, the American people have massive losers. They're the biggest losers. They've got those guys running the place.
I think you find minority parties, just like here, you know, we've had the minority parties in the Greens, and you know, you go back even to the Democrats that faded away.
The motorist enthusiasts.
Yeah, and you know, now you've got Palmer coming to the fore, but you know, I think the next election that'll sort of pull back a bit as well, and I think that'll happen to the Tea Party in the US as well.
Yeah, I mean, it'll take a bit to belt them down because they've got such funding base, but you know, I ultimately think there's going to be some sort of balance. We'll talk more about politics and the equity market and the bond market in a second, but we'll have to leave it there. We'll go to a very quick break. We'll be back in just a moment.
There's no place like home.
Monet and left foot.
Some people talk about you like they know all about you. When you dip it on the scene, yeah, they talk about it. 'Cause they can't talk about the scene, but you talk about it. Talk about it. When you get elevated.
Whatever their personality, every dog deserves leading nutrition. For healthy digestion, a shiny coat, immune support, and healthy teeth, choose Pedigree.
Go beyond the expected in Europe and Britain with Trafalgar and Harvey World Travel. With exclusive insider experiences, you'll delve deeper into Europe and Britain. You'll hear stories from local experts, watch artisans at work, and even dine with families in their homes. There's no better time to book your Europe and Britain 2014 holiday with Trafalgar's early bird savings of up to 10%.
With Harvey World Travel, we're the travel professionals.
World Vision works with parents so children can attend school and avoid early marriage, but we need your support. Help protect a childhood. Sponsor a child today. Call 13 32 40 or visit worldvision.com.au.
There's no place like home.
Monet and left foot.
Some people talk about you like they know all about you. When you dip it on the scene, yeah, they talk about it. 'Cause they came to see you talk about it. To talk about it. When you get elevated.
Welcome back to the Bonds and Equities edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities. Joining me tonight is Rudy Philip van Dijk from FN Arena and Francesco Destratus from Ord Minnett. They're here to answer any of your questions, and somebody has picked up the phone and they're going to call us, and it's David. David, you're from Newcastle. How's it all up there?
Good, thanks. We're in the fires, but thanks for taking my call. My question is, I have a self-managed super fund. I have some stocks and some bonds, but I have a bank note coming due, and I was just wondering what the panel thinks of First Max RMBs. Are they as good as they look, and are they safe as they are? Thank you.
So David is in Newcastle in amongst the fires. He's got a self-managed super fund, he's got some equities and some fixed income, he's got a term deposit that's coming due,
Yes.
and he wants to talk about First Max RMBS. The challenge for offering advice in terms of getting all the information from a customer is always quite difficult, and so you never want to speak specifically to a particular item. Does First Mac run good RMBS? Yeah, the short answer is yes. All RMBS at the moment has performed incredibly well. Residential mortgage-backed securities is a very good asset, but it's a very misunderstood asset.
Yes.
So the question that comes out of that, David, is where do you sit in that structure? Are you senior? Are you, where are you? Do you get the equity? My interpretation of most of these assets is that I look at a benchmark of what I want to try and achieve. And so I think if you can get 3% over the cash rate, that becomes an attractive return, and then you look at the risk. And a lot of the RMBS will be around about those sorts of levels. So the short answer is yes, you should look at First Max RMBS, absolutely no doubt. You should be able to compare it against other providers, so it'll be, I really like the ME Bank. SMHL is the ME Bank, so it's a union bank.
Yeah.
The quality of those mortgages are fantastic. The performance of those mortgages are incredible. It's all these guys who are industry super funds, people who've got long-term employment, and they're cautious people. So I really like those sorts of mortgages. So I think it's a question of comparing like for like, but in general, RMBS is a pretty good asset for people who take the time to understand it, which I'm guessing you haven't.
No. The only comment I'll make is I'd have a look at liquidity and as well, how do you exit these sort of things?
Well, yeah, I guess, if I buy a 5-year term deposit and I buy a 5-year RMBS, I've got no liquidity in term deposit either.
Sure.
So the term deposit being what it is, you're stuck with it. I do appreciate there's a liquidity value, and so what am I getting? And if you're seeing cash rate, you're seeing assets going at 100 over the cash rate and you get 300, your liquidity premium's crunched. The 300 for a reason.
Yeah.
You're looking at the quality of the asset and the role it plays. So if I buy that and Telstra, I know my liquid piece.
Sure.
That's sort of how I play it out. And these things have got some great performances, so you know how long you should be invested in these assets. Yeah. But it is education. The viewers at home, do not go and buy that Monday.
No, and I agree with both of you. I do think if you have a broader portfolio, you should watch liquidity. But I also agree with you that if you have a broader and you have liquid assets, it shouldn't deter you from having a less
like you
liquid
have
assets
that whole array.
in
So
your portfolio.
what's my liquid and what's my less liquid? Because I'm sitting on some equities that if I told my broker to sell, it would be a complete disaster because they're so illiquid. There's equities. So it's just a question of how does that composite portfolio look like? And I think they play different roles, and certainly.
Yes. It's also an argument that's sometimes being used with listed property and unlisted property. And I agree, unlisted property shouldn't be a problem if you have a broad enough portfolio.
And don't change why you bought something. I got a 10% yield on this unlisted thing, and I know what it is, and all of a sudden, your kids come up and say, "Hey, Dad, can I have a car?
I need money.
I've got to sell that because I love my kid." Come on.
But in a super fund, you've got to say it is a long-term. I mean, as long as you don't need to sort of draw down on
Well, that's the thing. So you need the liquid ones, and then you can afford some of the liquid ones. Yes.
You get those annuities for the liquidity, like they're spinning out cash. So those annuities spin out cash. You don't spend it all, and then reinvest in some other performing assets. So. Regarding the US, 3 months from now, what happens? Where are we with this? Is it?
I think we're going to go through.
Trying to wrap up.
We're going through the same process again.
Yeah.
You don't think they'll make a decision in advance? You think they'll go to the brinkmanship and do it again?
I'm not so sure about that. I mean, the thing I picked up when I was actually in the US at the last elections, and the thing I picked up is that the Republican Party really has to go through a lot of soul searching. I mean, they were convinced until the very last moment they're going to win that election, and it was a complete surprise to them. And they got belted, and they could not sort of explain it. So they really have to go through this soul searching, which I actually think the Labour Party in Australia has to do as well. They're almost in a similar position there, right?
Just think with the Labour Party, it doesn't have to be so public.
It doesn't have to be. It doesn't have
Go
to be.
and get a therapist. Work out why you don't like the guy, and then I don't need to know.
But
if you're giving a John Button speech, what's the tartness of it, the nastiness? You just think, oh my God.
But I think the thing is, when you go through that soul searching and you're finding your second you, basically, it's not necessarily a smooth process.
No.
And I think that's what you see with Republicans. They're trying to redefine themselves, basically. And it's not necessarily a smooth process. So I do not necessarily expect that in 3 months' time everything will be forgotten about and we're going to have a smooth process. We might just have the same thing again because the ones that are under pressure today will not necessarily be under less pressure in 3 months' time.
So, Francesco, what's the medium view for equity markets with that in mind, so that we've got some turbulence, potential turbulence? What it did, it sort of took the air out of the markets. What's the medium-term view for the broader equity market in your mind? And don't always say it's going up. Come on.
I'm a braggart, so
come on.
I've got to support the market. No, look, I think the market is pretty much fair value. Maybe a little bit overvalued at the moment, but you've got to remember that you've got to put into the equation the sentiment out there as well. And the sentiment's improved from where it was 18 months ago. I talk to people every day, and the market from where it was in June, July last year to where it is now, and they're sort of the way they're talking is as if they've missed out on something, and you've got to try and sort of bring them back to sort of reality and say, look, you're not in this for 5 months, 6 months. It's a long-term investment. Where do I go in now or do I not? Depending on the size, we say, well, hedge your bets, put some in now and leave some on the sidelines, because if it pulls back a bit, which it potentially could, now when I say pull back, 5,000 maybe, I don't see it back in the fours, and there's some good buying opportunities there.
He's laughing.
But if it keeps going, at least they've got exposure to the market, and they're getting some gains out of it. But over the next 3 months, well, I think we're just going to see more volatility, because every time someone opens their mouth in the United States, the markets are going to react over there, and they always knee-jerk react to anything. Well, if you look the other day, the market was up over 200 points at one stage there. What changed? Not a great deal. Fundamentally, the economy hadn't changed. So, but the markets are changing.
We've got a minute before the next break. What do you think for the next couple of months?
I think this whole where it pans out is I think the market will continue to go up on very low volume, which again highlights the conundrum for investors on the sideline. It will go up. There's no volume there, and you're sitting on the sidelines and you go, damn it, I mean, what do I do?
And as soon as you start buying because you finally hit that ticket, may or sell.
Exactly.
We have to go to another short break. We'll be straight back, but feel free to give us a call on 1300 30 34 35. Email yourmoney@skynews.com.au. We'll be right back.
It's really nice.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi!
Ben? Yeah. That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
Property markets are just as scientific as share markets. Instead of buying shares in a company, property investment is like buying shares in a community. Studying the science of property markets is our core business. A majority of investors limit their selection to properties close to home, and yet there are over 9.3 million properties throughout Australia. If our skills and experience can add just 2% to the average annual capital growth on a typical $400,000 property, then over 10 years, that's an extra $140,000 to your bottom line. Visit us at propertyology.com.au. We're out there working for you.
Maltesers, the lighter way to enjoy chocolate.
Welcome back to the show. If you have any questions on the bond or equity markets, feel free to pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. We'll take our first email for the night, and the email is from Angela in Balmain. And Angela writes, "Hi, I'm looking for a higher return than term deposits. Can you recommend what can you recommend?" Angela, do you want to talk that one through about what you can recommend?
Well, I think in the first instance, it sort of relates to her risk appetite. I mean, there are, as you probably will agree, there are corporate bonds out there which give a much better term deposits, but she could potentially get a higher return from the share market, but then the share market is also higher risk. I mean, it's very simple. If you have a good dividend payer on the share, and you still have them, not necessarily amongst the banks, they could give you 6 or 7%, and then if you add franking on top of that, that's a quite good return. But again, if the share market at some stage, which the share market always carries a risk of temporary blip or correction, whatever, you have the stomach to withstand the volatility that comes with the share market.
Yeah, because term deposits is clearly not the volatile piece that she was looking at. But some of those term deposit rates are now getting crushed. We've got 3 and 4%, and when you take into the tax and
you pay tax, exactly, yes.
You take tax and you take
and then inflation. You're basically going backwards, yes.
And the banks aren't sort of offering a little bit more either for larger amounts. You know, I've gone to them a couple of times and asked for a little bit more, and they're saying we've just got too much cash. We don't need to give more. So it's not as if you can try and get a kicker out of it as well.
No.
So the other thing she'd need to consider is what sort of cash flow she requires. So I would assume she's probably getting some sort of monthly, interest out of a term deposit or quarterly if it's paid that way. You can look at the subordinated notes and the hybrids that are listed, which are not as volatile as your equities.
Is there any hybrids in particular that you like, or?
I prefer the subordinated notes personally because they're simple. They're easy for investors to understand. It's pretty much a bond, if you like. $100 face value, pays an interest rate.
So are there any is there a minimum amount you have to spend?
Well, they've generally got a face value of $100.
Yes.
So generally with the market, you're looking at your minimum investment is $500, and the registries don't like registering anything under that sort of thing. So you're looking at $500.
So it's only $500.
Really? Okay. But they, a lot of them pay quarterly payments as well, so incredible as well. And they're paying a reasonable margin above the bank bill rate. So you're getting that little bit more than you would over a term deposit, and you're getting
not as risky as equities.
If you buy them in a bank, it's as safe as putting the money in the bank.
We have a caller. It's Ian from Sydney, and Ian wants the panel's view on fixed income for an SMSF. Ian, are you there?
Yes, hello, Mark. Good evening, panel.
Good evening.
Yes,
we can't hear it. No, we can't hear it.
So Ian, if you can just wait a second, if the studio can hear this, we can't hear you. We have a person below the desk working that out for us. So, Ian, carry on and I'll pass it through.
All right. Mark, I've established a self-managed super fund and I'm retired.
Yep.
And I'm looking to allocate a sizable, a seven-figure sum of money.
Yep.
And I'm of the view that given the USA and Europe and all the other uncertainties that exist in the world coming up, that at best it's uncertain. So I'm seriously considering, allocating certain sum of money to FIIG Securities.
Yep.
So I guess I have two questions. First question is the panel's view on having fixed income in a self-managed super fund, given what I've just said.
Yep.
I'm picking up on the previous caller's term deposit aspects.
Yep.
And if there is view, and I know you would have that view, that FIIG Securities should be in the portfolio, what sort of proportion and the type. I regard myself as a conservative, balanced sort of person, so that might assist in the question that I'm proposing.
And Ian, can I ask one question? Can I just get your age?
Yes, I've just turned 60.
Okay, so I'll just explain what we've got going on. Ian's got he's got a seven-figure sum, he's got a self-managed super fund he's setting up. He's concerned about the fact that there's so much volatility in the geopolitical stories, and so he doesn't have
being caught with a lot of volatility, and he's saying, should I have some fixed income in my portfolio, and if so, what sort of volume should I have of my investment? He's just about to retire, so he's 60, I think Ian said he was. What's your interpretation of a client came in and gave you those broad ambits? So he's obviously got a good sum of money. So he's worked, he's about to retire. Yeah. Where would you, and at a macro level, what would you talk to Ian about?
It comes down to asset allocation. You've got, you can't, the old adage, you can't have all your eggs in one basket.
You better not.
You better not. And if someone's about to retire, which means they're looking for stability within their investments, I'd probably have a 50% weighting, if not a little bit more, in fixed income.
Yeah.
And obviously a lot less in the volatile investment area like property, and well, property's not as volatile as the share market, depending if
then there's your liquidity.
Yeah, but he needs the liquidity, so that's where you're in more liquid assets in the smaller end of the market.
Yeah, and so what? I'll just bump in. One of the things that we use at FIIG is this idea that you invest to your age. So 60% fixed income. Within that 60%, they play different roles. So we would say that you would have some floating rate notes above 300, so you've got a nice little spread there. I actually think you get some nice fixed income returns in that 2018, 2020 bucket, Ian, that gives you over 6%. And then I'd buy some inflation-linked bonds. So because you need to have that componentry that grows at inflation plus. So that's a portion of your portfolio. So if you think of it, there's a portfolio within a portfolio. That's how I think about it. And then you buy some growth assets, which will be some good equities.
Well, we do that with equities as well. We
absolutely.
have, X amount in equities, and we have a portfolio within that.
So I personally think you can play around with the interaction between fixed interest and equities, depending on which type of equities you choose.
Sure.
You can get a little bit more defensive in maybe a little bit more backbone dividend payers, and then maybe that can compensate a little bit for maybe fixed interest.
But I just
as long as you pick them, you pick right
ones. You've got to be in defensive.
But the point I'd have for Ian, and I hope you're still watching the show. Today you're 60, and today you're starting to become an investor. And Warren Buffett started when he was 10.
Yes.
And so you need to be able to say, I need to invest to my experience. So whatever your job was, whatever your role was, start to use the skill set that you picked up around that.
Yes.
And let's say you're an engineer. Look for engineers. So if you like Downer and you work with them, buy some Downer bonds. That sort of, and I'm not being as obvious. Do you know what I mean? I'm not being as simplistic as that. But still apply your life's experiences rather than saying, had a cup of coffee with somebody and he said, I really should punt on this thing. That is the last thing you need to be doing. You need to build a portfolio that can withstand volatility and your mistakes.
Yeah.
I mean, I think that's the best way to look at it.
Yes.
Look, we'll go to another quick break, but thank you for the phone calls. Feel free to call us again, 1300 30 34 35 for any questions you have on investing. The email is yourmoney@skynews.com.au, and we'll be right back.
Should have said.
It's really nice.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi.
Ben?
Yeah.
That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
Hey kids, look at this. It's called forward collision mitigation. It's like the car has its own eyes. And then there's adaptive cruise control. Do you hear that, Jane? Adaptive. And don't get me started on MMCS. It's amazing.
Mission Control to Orbital 1. Do you copy? Mission Control to Orbital 1. Tom? Tom, do you copy?
The new 2014 Outlander. With so much technology, it's out of this world.
With CFDs, I can trade on the rise and fall of indices, shares, forex and commodities.
It's important I can pursue 24-hour trading opportunities and still control my risk.
I use CFDs when I want to trade the markets without putting up the full value of my position.
That's why I trade CFDs with IG, the global CFD specialist, creating opportunity since 1974.
Thank you. That'll be $10, please. Okay, here's all of my card details. $250, please. Okay, here's all of my card details.
That'll be $150, please.
Okay, here's all of my card details. Oh no!
Stop giving out your card numbers all over the net. No one sees your financial details when you check out with PayPal.
Welcome back to the program. If you have any questions on the bond or equity markets or the United States, feel free to call us on 1300 34 35, 1300 30 34 35, and the email yourmoney@skynews.com.au. Gentlemen, I just, we gave Ian some advice on how to construct a portfolio. What's the low-hanging fruit? What's the thing that you would say, I think you should be looking at this, or maybe there isn't any? So I'll start with you, Rudy. You've been nodding. And
yeah, no, I to be honest, apart from some individual stocks, which there's always some individual stocks in the share market, yeah? But apart from that, I think at this point in time, I don't see much of low-hanging fruit. I do think that a lot of the fixed interest is priced, and I do think a lot of the equities are priced as well. And I think the problem in the equities market is that a lot of stocks are priced for what is yet to come. Yeah. Which in itself then bears quite some risk.
You need the PE expansion to get the follow through.
And it yet has to follow through the earnings. So
look, I slightly disagree with a little bit with Rudy. I think he's right that the share market overall is showing signs of pretty much fair value and maybe a little bit overvalued, but not too much.
Yep.
And I agree with him that you look at some individual stocks and there's some stocks that are showing, I think, some good value. So something like Lendlease, which has got a $66 billion workbook in front of them, not exposed or not heavily exposed at all to mining capex. Mind you, it got sold down when all the other engineering companies got sold down because of that. I think there's real value in a company like that.
So where's that trading relative to where it had traded?
Oh, look, it traded all the way up to above $11 there recent times, and then when stocks like United Group and Leighton's and all that got hit because everyone realised that the capital expenditure's not there anymore, it got hit with it.
So where would it roughly be now? Leighton's?
Leighton's is trading at 10.
Sorry, Lendlease, a big fund.
Lendlease is trading around 10.60. I'd stay away from Leighton's. The issues they got.
No, they've had some problems. I've read about those guys. They've had a few problems. Corporate governance.
Yeah.
See, that that's on the category. Sometimes stocks are cheap for a reason.
Yeah. I mean, in the response to that business, I mean, the stuff you read now, it's quite extraordinary, isn't it?
Yeah.
And you sort of you presume a lot about companies. It's all about the marketing of themselves.
Yes.
These are, fiduciary responsibilities that we take very seriously. With this, with that, with the whatever. You just think of them, and then all of a sudden you read in the paper, you go, "That's not the sort of take I had on that company."
Yeah.
I mean, in hindsight, and I know until a few years ago, Leighton was considered a blue chip in Australia. But I think in hindsight, that was definitely the wrong label. Huh?
Yeah.
It never was that. And I do think that's what's one of the weaknesses we have in equities. Like in the bond market, you actually have a label on a bond showing everyone this is a risk and this is more risk and this is less risk. In the share market, they all look the same.
I mean, that's what I always try. It stuns me that the bonds have got these capital structures which identifies what they are, and they've got these documents that say this is what this bond will do, this is what it's allowed to do, this is the limitations, this is the payments, everything. And then I read they're dangerous. They're risky. Why? Because you can't read. I mean, seriously, what is the story with that? How did the bonds are the anti-latents? They've got the worst marketing performance ever. They can't articulate themselves. The Julia Gillard of investing. I mean, you've got to be able to talk your own book, and it's just sort of. I love Julia Gillard for her bravery and everything, but you'd say she just could not sell things, and you need to be able to have somebody that can make Bond not seem. It's not James Bond, but it's something like it, a little bit sexier, because the low-hanging fruit in my mind. I always talk about Sydney Airport inflation. If inflation is at present levels 2.5, you'll get net 7%, 6.75%, 7% for a senior bond,
which is a steal. I agree.
It's just kind of nuts. And there are, I think, some of these investment grade bonds at over 6%. I think Telstra 20s gives you a net 5%. But it's rather than a term deposit by the Telstra 20s. That's what's from at different roles. So I think everyone could just take a breather and look for some good value at the moment rather than just everyone diving in. It's a bit dangerous.
Going back to the portfolio question we had earlier, I think what a lot of people have to understand is the attraction of the share market is always you can virtually double your money overnight. That is the share market. You can't.
Never done it.
You don't do that.
I've read about it.
Exactly. You don't do that in bonds on.
I've been doing it for 20 odd years. I've never done it. I must be the dumbest share investor.
No.
I've never done it.
Because the problem with that is that you can't focus your whole portfolio of trying to achieve that, because you will ultimately end up with disappointment. You have to have a backbone of stocks that do not, with 100% certainty, do not double overnight. But you know what? They're not going to drop by 40% either.
That goes back to risk and return.
Yes.
I mean, ultimately, you go into a bond market, your return is pretty much capped, but you feel safe investing in bonds. Whereas in the share market, depending on what end of the share market, you could be hunter right down the low end of the market, and you could double your money overnight, or you could lose it all overnight.
Yes, exactly.
But you could go into the banks and the blue chip companies, and I know you don't like the term blue chip, but
well, not in the case of Leighton.
They're not going to double overnight, but that the share price is going to be volatile, and what happened in 2008 was an event that probably happens only once every 20 or 30 years anyway. And the share price
be careful there. We had the same thing in 2000.
But that was only in one sector, really. I mean, ultimately, and the dividends are going to be fairly sound. And you go back through the track record of companies and you look at the dividends that particularly the banks have been paying. I mean, ResMed, when they put out the result this year, was the 74th consecutive quarter of increase of growth in their earnings. Now, you show me a company who can do that 74 quarters in a row.
How many companies do that?
And that's the problem. And that's also that's almost the mask of the share market. Everyone focuses on the shares that go up every day. But in the background, like for instance right now, and this is quite astonishing, the strategy that has worked, and the best strategy in the past 3 years, both in Europe, in the US, as in Australia, is dividend growth. So it's not trying to pick the cyclical that's gonna rally overnight. It's a dividend growth one. These companies that have steadily increased their dividends year after year after year have been proven the best strategy to follow.
So long as they're not selling back their own capital, so long as they're not borrowing from the bank.
And the irony is most of those companies are not on the front page of the
that's classic. You say they're not geared or anything. Lend-Lease went through the GFC with 2% gearing. They're a little bit higher now because they're in a phase of expansion and that, but show me a company that went through the GFC with 2% gearing on their balance sheet. I don't think it's too many.
Yeah, that's right. No. We'll have to leave it there. We'll have another very quick break. We'll be right back in a moment to answer any more of your questions or your emails. Feel free to call us. We'll see you soon.
A marine expo so large it can be seen from outer space. A 3-kilometre display circuit over 30 hectares. The Gold Coast International Marine Expo. From super yachts to trailer boats, kayaks to jet skis. Step behind the scenes of Australia's largest boat factories and shipyards. Plus, action-packed attractions for the whole family. Gold coin donation entry with free on-site parking. The Gold Coast International Marine Expo, November 1, 2 and 3, Coomera.
Always interest in horses. Decided to acquire a few young fillies. All of a sudden, quite a few racehorses. Insurance, horses, houses, horse trucks, fencing, steadfast broker Ron, comprehensive cover. Highest rated filly, the foal was dead. Money to us within days. When the chips are down, steadfast. Strength when it's needed.
Insane prices, these prices can never be repeated. You think we're mad?
We don't need to do ads like those. Because we're so confident our prices are the lowest, we just guarantee them.
Stock up on this FIIG Xerox laser print copy paper, only $2.50 per ream. And take all your files with you on this ultra slim Toshiba 500 gig hard drive, just $59. All backed by Officeworks' lowest price guarantee.
So there's no need to shout.
If you've got the big ideas, Officeworks at the lowest prices.
Welcome back to the Bonds and Equities edition of Your Money, Your Call. We are still taking calls. The phone lines are open. They're 1300 30 34 35. The email is yourmoney@skynews.com.au. We had low-hanging fruit. What are you worried about? Is there any dark clouds on the horizon? I can start with you.
There's always a dark cloud out there.
Yes, that's
and
true.
Particularly with the media, they'll try and find one anyway.
Yeah. In particular with equities, I would say.
Look, I think the concern for me at the moment is what's going on in the US. And I think ultimately they'll come to some sort of solution, and calmer heads will prevail, but it's the negotiations, the messages that come out before they come to an agreement is always going to make the market more volatile. As I mentioned earlier, you said the US market moves 200 points, but nothing's really changed a great deal for the market to move that much. Sure, confidence and fears come into it a little bit, but for the markets to move that much, I think it's a little bit ridiculous. But the US has always done that. So that concerns me a little bit, is creating a little bit more volatility.
But I would have thought, maybe, and if I was looking at it from your business, and I'd be thinking, one of the concerns I would have is that, to your point, so many guys have sat on the sideline, they then go in, they're buying at the highs, get another bang, and all of a sudden these people will not buy equities forever. It's because I think they're still on the sideline for a reason, that they have got memories. And I feel that's the concern I'd have in the equity space, that the people that sat with cash rates going where they are, and all of a sudden jump in because they think, it's all okay.
Yeah.
And what are you worried about? What's the...
I'll leave the international picture to Francesco, because I still think that whole situation he's describing will simply allow the share market to go high on low volume, which is his own respective problem. I'm more focusing on the domestic picture. And as I said earlier, I think the worry domestically is that while everyone is now convinced that we will have an upturn domestically and the margins will increase and we'll finally have profit growth and etc. but maybe we won't have it as fast as we all pricing in and we think we are having. Because I noticed just one thing, the currency is almost heading back to 97 cents again. And it wasn't one of the things we needed was a cheaper currency to finally get those margins moving. Yeah?
I mean, I think the economy is incredibly fragile. I think the consumer is driving the whole narrative. So the consumer's behaviour is very important.
Yeah.
More than capex that you're talking about in terms of the corporate activity. And why wouldn't the consumer, when you look at it in the employment, we made the point earlier that we think there's going to be some industrial relations reform, there's going to be some productivity gains. The consumer just says, have I got a job? It's just a very nervous job market. And the RBA has spoken to that move cash rates down as low as they have, and no one's done anything. And that's the problem, trying to get the consumer to behave in a way that they had traditionally behaved.
Well, I think you hit nail on the head. You can move cash rates down to zero. The consumer's not going to buy it unless they know they get a job.
Yeah.
And more so, you won't get a consumer boom unless you've got a job market where they can resign from their job and know they'll get another one tomorrow.
Yeah.
That's when you really get the consumer starting to spend.
And I would like to draw on the businesses here. I think too many people are too confident that an increasing in business confidence will lead to more investments. Yeah? I still think if those businesses do not really see an improvement in their businesses, they will be a little bit holding back on their
I think those confidence numbers now are a bit of an anomaly from the election.
Yes, I agree.
We've got all that built-up negativity from
yes, and it pretty was negative.
Yeah.
It was, yes.
And that's sort of just given a bit of a
Mr. Rabbit is negative in it, or he's
and we all know that change of government doesn't it's not going to happen overnight. It's going to be a long-term process. Yeah. So I think business people I talk to say it's not necessarily where rates are for them. If the Reserve Bank had rates at say 4.25 or 4.5, they don't care as long as there's some clarity and stability in rates. They're happy to pay because they're not paying the mortgage rates. They're paying a bit higher anyway. Yeah. But what they want is the red tape removed from doing business. I talk to people in construction. I talk to people a lot in construction. They say the red tape that they have to go through just to get a project started costs a lot of money.
Do you think we're in a property bubble?
No, look, I don't think so. I think, because you look at pockets, and Australian property market's funny. I'm not a specialist in property, but you can see that, the Western Australian market's starting to soften a bit or quieten down a bit because of the mining boom starting to slow down a bit. Well, the capex side of it is anyway. The city market's starting to sort of get a kick along at the moment, and we're seeing that in property prices. But I think that's driven a little bit by there's been some underinvestment in the past, and we're seeing, home loan or borrowing for property start to increase through the investor. So I think over the next 12 months we'll potentially see some construction activity. I hope that turns into, and that's what the Reserve Bank's been trying to do, shift that investment over from
into construction for
mining into construction. But as far as a property bubble goes, no, I think we're a little way away from that.
What do you think?
I don't think it's a bubble. It can potentially become one in time. I don't think it's a bubble, but it's. I think the term bubble is being used by people internationally judge property markets on a very rough scale. Mm-hmm. They're sitting in New York somewhere and they look at. Yeah. I mean, every property market has its local oddities and characteristics, and obviously you can't just judge. I mean, Australia from New York, but Australia has a few characteristics which make it really in particular, basically. And one of the characteristics, I think, which hasn't been mentioned often, but there's according to some estimates, 1 in 6 houses in Australia is being bought by someone who does not live in Australia.
That's the key to it. That's the key to this whole property thing.
That's a lot. That's 1 in 6 is a lot.
That's it. That's the number. I mean, that's what I've been. My theme is the problem with the property bubble concept is how does the RBA react? Does it lift rates up? And the thing I feel is that the homeowners are actually missing out on the trade. They're not buying and getting more. No. It's other people who are buying these houses on speculation or for different roles. Yes. And all of a sudden, the consumer is so sensitive to those interest rates. It's just paying its debt off as best it can because employment's weak. If the RBA was to ever consider to lift rates, that would just crush these people because it just pull their heads right in like turtles. So I feel that it's maybe not a bubble, but it's got momentum. And people are changing their behaviour, so builders are going out and doing things. And I feel that the RBA will be looking at that and saying that's not quite what we expected.
No. It's also, we do surveys every 2 months about investor behaviour, and we've this year definitely noticed that some of the cash on the sidelines is going into equities, but only very gradually so. And there's definitely cash from the sidelines moving into property.
Yeah, right.
And I think that is because people feel that property has momentum. and they feel the risk is lower for a 40% decline, like we saw in 2008.
Yeah, sure.
And they think it's not going to happen with property.
Well,
if I own it for long enough,
and I can just rent it out, and I'll take the hit on some sort of valuation process, but I can afford it because I have a job. The bank lent me the money. It's time for a short break. We'll be right back in just a moment for the last segment.
It's really nice.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi!
Ben?
Yeah?
That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
Go beyond the expected in Europe and Britain with Trafalgar and Harvey World Travel. With exclusive insider experiences, you'll delve deeper into Europe and Britain. You'll hear stories from local experts, watch artisans at work, and even dine with families in their homes. There's no better time to book your Europe and Britain 2014 holiday with Trafalgar's early bird savings of up to 10%.
We're Harvey World Travel, we're the travel professionals.
Hey kids, look at this. It's called forward collision mitigation. It's like the car has its own eyes. And then there's adaptive cruise control. Do you hear that, Jane? Adaptive. And don't get me started on MMCS. It's amazing.
Mission control to orbital 1. Do you copy? Mission control to orbital 1. Tom? Tom, do you copy?
The new 2014 Outlander. With so much technology, it's out of this world.
Start up like this, or like this, and hit the start button to flip back and forth. You can make the important things big, keep the small stuff small, and arrange it all around you. You can be all work, all play, or even both at the same time. You can do it all, simpler and easier, on your Windows tablet, PC, or Surface. That's the new Windows. One experience for everything in your life.
Welcome back to the last segment of the night of Your Money, Your Call, the Friday edition. We'll get straight back into it because we have a caller. We have Arnie. Arnie from Sydney would like to talk about Silver Chef, cash converters and some bond issues. How can we help you?
Look, I would just like the panel's view on just those corporates that can access the Australian bond market. I mean, Silver Chef and cash converters have done it recently. Whether those issues went well and how they've gone post their issue, and whether you think that other Australian corporates can access the Australian bond market, and do they get a re-rating from that in their equity prices?
They're great questions because when you see these charts, they are completely incredible. So the first one, these are all, and I don't know, Arnie, but these are all led by FIIG.
Yeah.
So Silver Chef. This is one that we did, which was G8. You can see that the performance, that's only in the last quarter, so the market rallies very hard. Essentially, the bonds are really well constructed, put together bonds that give you a roundabout. They're trading roundabout par. So the latest one we're doing is one called PMP, which is about 8 3/4 for 4 years.
Okay.
And so Silver Chef and CCB are both trading at around $100, but it's about 100.75, so slightly higher than the issue price. But if you can bring up the SIB chart, it was a $30 million issue, and if you watch the equity performance on it, what it essentially does is it brings to the equity world the bond investors, and they start to see these issues, and they see the benefits. So you can see Silver Chef has just absolutely taken off. And Silver Chef is a great little business. They're run out of Brisbane. They do business-specific lending. So, in other words, if you are opening up a cafe, they'll do the barista piece. They'll do the coffee shop.
They basically take the risk on board, and
they take the risk. Yeah. And what they do is they turn these things over very quickly. So Arnie, they performed incredibly well. And if you've got CCV, it's cash converters, which was the second last one we've done. We've done PMP and cash converters, and again, the equity performance in all these have just been fantastic. Cash converters had a claim by Blackburn and Co, the lawyers. They made this outrageous claim, and it was, you know, they wanted $40 million, and these guys have only got 18 stores in New South Wales, and they went, what are you doing?
I think what the market missed in all this is that the Australian component of cash converters has become a lot smaller now. They've branched out internationally. They're much bigger.
They're a great organisation, and what it is Arnie, it's the access into the bringing high-yield corporate bonds. If you're familiar with the United States, the high-yield corporate bond market is very comfortable. And so what they've done at FIIG, and again, other people should be doing this, but what they've done is taken the documentation for a high-yield corporate bond, so it's a limitation on debt, it's a limitation on dividends, it's limitations on senior debt, senior secured debt, so that you, the investor, are protected. And then, you know, we've done the PMP one is linked to where their contracts mature, majority of them mature in 4 years' time, and they roll them forward. But, you know,
Mark,
it's just these protections you want to apply.
How much does the cash converters, what's the nominal yield on it?
It's about 7.3 for cash converters. So they're all in the high sevens.
Yeah.
You know, 7.5, 7 3/4. PMP was high.
See, I would personally, I know cash converters a little bit, and I didn't know about the bond. But I would personally, at this point in time, I would probably prefer the bond over the equities, to be honest.
I think there's that clash of that clash around: am I in a growth asset, or am I looking for dividend, or looking for an income? And in truth, Arnie, you know, you should have a bit of both. If you looked at SIV, CCV, these sort of organisations, PMP will do the same, is that you buy a bit of both and they play different roles. We keep talking about that. It's just the cash that you're going to get. And once you see the story, CCV was a classic.
What's the yield you're getting out of the bond in Silver Chef?
Silver Chef is now round about, that's probably about 7.25, 7.5. I mean, they're all trading around about the same price.
It's still pretty high.
These are all high, you know, they're all over 7%.
And I'm not surprised that in the case of Silver Chef that it actually supported the share price, because what it actually does to the company, it actually gets extra funds which you can invest in growth, and it doesn't dilute the shareholders.
Well, you know, the other thing to note, Arnie, is that G8's trading at 7.30. All these organisations get access to tenor. So tenor being, for the viewers at home, it means long-term investments. If you go to a bank right now and you're a corporate, they'll give you 3-month money, 6-month money. If you're these sorts of corporates. Now, G8 is a $600 or $700 million company, and it will get investments from the bank, and that little lending from the bank, and that's all fine. But it might say, I would like $40 to $50 million of 6-year money, because that just takes a little bit of the pressure out of my markets. And banks at the moment are lending, but they don't always lend. And that's the key to it. Just, you know, mitigating some of your risks around what you're looking to pay for cash.
Absolutely.
I think that's all we've got for tonight. So thank you very much for coming on the show. Thank you very much for all our phone calls and our emails. So to Rudy and Francesco, I hope you have a wonderful weekend. To all the viewers, thanks for calling and thanks for emails. I'm Mark Todd from FIIG Securities. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with